All right, so let's carry on here. So let's talk a little bit about some of those things that aren't taxable, that are specifically excluded from taxation. And many of you will remember from payroll accounting some of these items, employee fringe benefits. So if your employer pays for health insurance on your behalf, you are economically better off, right? Because now you don't have to pay for health insurance, but that is specifically excluded. It is not taxable income. The value of that is not taxable income to the employee. Employers oftentimes will make retirement contributions on your behalf as well. So if you've got a 401k and the employer will match some portion of what you put in, that again is a non-taxable benefit. That will not, you'll eventually pay tax on it, provided it grows in value, when you retire and you receive that retirement income. But at the time that the employer is making that contribution, that is not considered to be taxable income. Now there's also another list here, some items. So no additional cost services provided to an employee, a spouse, or dependent children. They ordinarily would have to offer the services for sale to outside customers. The employer must incur no substantial additional cost. So an example of that might be, a good example actually, is an airline seat. So if you work for an airline and the airline happens to have an empty seat and they offer an employee use of that seat to go somewhere on vacation, that is, there's no additional cost to them for having you sit there, and they're not out any money. So in that case, that would not be taxable. Certain discounts. So and this would be more common like in the restaurant industry and in retail industry, up to 20% of the normal selling price would not be considered taxable income to the employee. Now in reality, does this happen? Well, with small businesses, probably not so much, especially like restaurants and things like that. Employers tend not to keep track of those things, but technically speaking, any discounts that are for the employee's benefit would be taxable over and above a 20% discount, okay? Other working condition fringe benefits, let's see. Professional organization dues, that's a good example. So as a CPA, my employer, when I was working in public accounting, my employer would pay for my continuing education and would pay for the renewal of my CPA license every year. I did not have, that was not considered taxable income to me. That's one of those working condition fringe benefits. Also, employer provided vehicle for business purposes. So if the employer provides a car to the employee, any business use of that car is not taxable to the employee. You're doing business for the employer. Any personal use of that car, however, would be considered taxable income, and there are specific calculations for that. We're going to go through that in much more detail in Chapter 6 when we talk about self-employment income. Qualified transportation fringe benefits, so transit passes, it's like bus passes. I know like DMAC, I don't know if DMAC actually pays for them, but DMAC offers bus passes to employees, also to students as well. I don't know if you're aware of that. You can get a free bus pass on DART. Parking, or what else here? Yeah, parking. That is generally speaking non-taxable to the employee as long as the benefit of it doesn't exceed $280 a month. In bigger cities, you might see a lot of people have to pay for parking, and if their employer pays for that parking space for them, up to $280 is non-taxable. Also, transit has like light rail, that sort of thing, as long as it doesn't exceed $280 a month. Other types of de minimis benefits. What the heck is a de minimis benefit? So, small things, little things that the administration of it would be too much to, it would cost more than it's worth to keep track of it. So some examples they've got here: turkeys, holiday turkeys, company picnics, flour, coffee, that sort of thing. It would just be too much to try and keep track of that. All right, some of these, again, these are items that we went over in payroll accounting, so you should be familiar with a lot of these items. So health insurance, which I already talked about. The value of the premium paid by the employer is not taxable to the employee. Educational assistance, so tuition reimbursement up to $5,250 a year of educational assistance is not taxable to the employee as well. If you happen to work for an employer that will provide that, that's a great deal. Let's see, what else do I want to mention here? Oh, employer pay, remember this, the term life insurance? Remember looking at that in payroll accounting? So up to $50,000, as long as the benefit is $50,000 or under, then the employee doesn't have to pay any tax on the premiums that are paid by the employer. But if the benefit, and I know using benefit and premium here, it can get a little bit confusing between the two. If the benefit is over $50,000, so that means if the employee dies, their family is going to receive a life insurance benefit over $50,000. The value of the premium that's paid that goes toward the benefit over and above $50,000 is taxable. But up to $50,000, that benefit is not taxable. Dependent care assistance. Oh, I skipped the meals. So meals and lodging, you remember, if it's the difference between if it's for the benefit of the employee versus if it's for the benefit of the employer. So if it's for the benefit of the employer, it is not taxable to the employee. If it's for the benefit of the employee, then it is considered to be taxable. So that would include meals and lodging expenses. Dependent care assistance plan. So this is, I don't know if you remember talking about this in payroll. Employers can set up plans where the employee can have amounts withheld from their paycheck, and that amount then reduces their taxable income. It gets set aside into a separate account that they then draw upon. The employee then draws upon to pay for child care. Up to $5,000, $2,500 for married filing separately can be excluded from taxable income. Cafeteria plans, you guys should know all this stuff because we covered it in payroll accounting. So these are all of those non-taxable employee benefits that are covered extensively in payroll accounting. All right, any questions on those items? No? You all remember talking about that stuff in payroll? Yes, okay. Yes is the correct answer. Okay, scholarships and fellowships, generally speaking, they are non-taxable as long as the proceeds are used for education and for the purpose of the scholarship. If, however, any amount is received over and above the actual expenses, then that amount would be taxable to the recipient. Or if the amounts if they were supposed to be used for scholarship, for actual tuition, room, board, that sort of thing, and they weren't used for those purposes, then it would be considered taxable, okay? Let's see, so here's an example of how this might work. We've got Hilda, graduate student at State University. In 2022, she received a scholarship of $7,000. $4,000 of that toward tuition and fees, and $3,000 to pay for campus housing. And she received a graduate assistantship that paid $5,000. The tuition, fees, and books were $6,000 during the year. In this case, Hilda can exclude $4,000 from her income. The rest, the other $3,000, is going to be taxable. She's required to report as wages, so the assistantship would be considered wages, and she does have to pay tax on that. The $3,000 that went toward the housing benefit would also be taxable. I misspoke earlier. I said room and board. I meant to say books. So only those amounts that are for tuition, books, supplies, and that sort of thing. Any assistantships though that are received, or even like residence assistants, research assistants, teaching assistants, those are considered to be wages because you are receiving those benefits in exchange for your efforts. Okay. The scholarship itself though is not considered to be taxable as long as it's used for the purposes that that it was received for. Qualified tuition program withdrawals. So these are most times we know these as 529 plans. Individuals can set up these plans. A lot of times parents will set them up or grandparents will set them up for their children. They put contributions into the plans for the student to eventually draw upon that to use for school purposes. As long as the funds are used for, and there's a much broader, you have a much broader ability to use these funds. The scholarship is just for that tuition, books, that sort of thing. This can be used for more uses. If you draw those funds out of there, it is tax-free, and any of the earnings in that account are not taxable as well. So you'll put money in these accounts, these 529 plans for children, and they'll ideally increase in value, right? Earn interest, or you put them into investments and they increase in value. You contribute $2,000, and by the time they go to college, it's $10,000. That would be great. When they draw that $10,000, even though it's earned $8,000 of income within the account, it's non-taxable as long as that $10,000 is used for education purposes. So that's what the qualified tuition program withdrawals are. Now, if they are used for something else, then the earnings portion of that is taxable, and there's a penalty on that. So it has to be used for educational purposes. Life insurance proceeds, we already talked about that. If they're payable because of the death of the insured, then they are not included in gross income. Any cash out of life insurance though that's not due to death could be taxable. Part of that could be taxable. The earnings portion of that. And that's kind of a, let's see. So here's an example of this. Jamie entitled to receive $50,000 of life insurance payable because of his wife's death. Instead of, oh, this is for if it's spread out, sorry. I wanted to use that. So instead of receiving a lump sum, he agreed to take 5 annual payments of $12,000 each. So in that case, because he agreed to spreading it out, he's actually receiving more income. The benefit was $50,000. They said to him, hey, if we pay you $12,000 a year, which essentially means you're gonna, for the next 5 years, which essentially means you're gonna get $60,000, you end up with $10,000 more. You took that, the additional $10,000 though, part of that, the $2,000 of each of those payments would be considered interest income. Does that make sense? Because he got more than what the benefit actually was. So that would be one of those cases. What else? Gifts and inheritances are tax-free. You don't have to pay tax if you receive them. That's for the federal government. Iowa does have an inheritance tax that depends upon the relationship. The individuals, if it's a spouse or child relationship, there's no inheritance tax, but if it's like a niece or nephew, if they're removed from immediate family, then there is an inheritance tax in Iowa. But for federal purposes, there's no inheritance tax. Meaning, inheritance, if you inherit money, you're not going to pay any tax on that. Now, it could be, depending upon the value of the estate, it could be that the estate itself, so the person who passed away, their estate has to pay tax. But the recipient of any inheritances will not pay tax on that income. Now the amount that you have to pay, or the amount of inheritance that you have to receive before you get to that point, last I knew it was like $10,000, or $10 million. It could be higher than that at this point. So we're talking about large estates here, but for the average person, the vast majority of people never have to deal with inheritance tax. Gift tax is kind of related to estate tax. We call it estate tax rather than inheritance tax because it's a tax on the estate, not the inheritance. Gift tax is related to that particular tax. So if an individual were to give during their lifetime more than what that $10 million amount is for gift tax, then there might be a tax on the gift, but it's always on the person giving. It's never on the recipient, okay? So if grandma gives you $3,000 for Christmas, take it, enjoy it, you don't have to report it, okay? Encourage her to do that. Questions? No? Let's see. Okay, so also, shut that. Also excluded compensation for sickness or injury. So this would be workers' compensation, different from unemployment insurance. Unemployment insurance, unemployment compensation is taxable. Workers' compensation, though, is, again, you're not economically better off. The payments are to make you whole again. So payments received under workers' compensation, any damages as a result of physical injuries or sickness, so you get into a car accident and you receive payment from the person who hit you, it's to pay for your medical bills. Again, you're not economically better off. In fact, you could be economically worse off. But any punitive damages, so this as punishment for the person, if a jury awards punitive damages or a judge, then those punitive damages could be taxable, considered to be taxable income. Let's see, pensions or annuities for personal injuries or sickness from active service in the armed forces, Coast Guard, public health service, or foreign service, so that's very specific. Also, disability income resulting from a terrorist attack while in the employ of the United States engaged in official duties outside the United States, so foreign service employees. I guess that's one of the benefits of being in a terrorist attack. Let's see. Certain adoption assistance, if the employer provides, and we'll go through some of this as well when we get, I can't remember which chapter this comes up in, but so if an employer provides you with funds to help with adoption expenses, those funds are non-taxable to the recipient up to $15,950. There is an AGI limit. So remember I said AGI comes into play in a lot of different places. This is an example. So once you reach AGI of those amounts, that benefit, then any benefits that you received may be taxable. Okay. Let's see. Why are both of these in here? They've got two. Wait, what is the difference here? Provided adoption assistance increased to $15,950. Employer provided adoption assistance increased to $14,890. I think it's just this first one. Child support is not taxable. That's not the same as alimony. Alimony is taxable. Alimony is taxable under certain circumstances. Child support is never taxable. Child support that is received is never taxable. It's never deductible to the individual paying the child support. Public assistance payments, like welfare payments, are not taxable. All right, I don't know why they've got two different numbers. I already talked about the adoption assistance. All right. electronics to software, which you guys are not doing that one. Okay, questions about any of those items? Of course, this is not an exclusive list, and I will tell you that tax accountants spend a lot of time researching this kind of stuff, because there is so much variation between it, and there's a lot of, it's vague, but this is one of those areas where tax accountants will spend a great deal of time trying to determine whether something is taxable or not. Yeah?
So if you receive like workers' compensation, you wouldn't have to put that on your taxes, like they wouldn't give you a form or anything, they just, okay.
Nope. Because it's for an injury. It's to make you whole, again, to try and get you up to where you were before. Other questions?